Well, folks, it looks like Christmas is coming early this year, and we must have been good because the present that Santa is bringing all of us is an amazing one. Pattern day trading, aka the bane of my existence, aka the dumbest rule and regulation in the entire US capital markets, is going to go bye-bye. Yes, you heard me right. Regulators are considering getting rid of pattern day trading. Just when I thought that there wasn't going to be anything exciting to discuss with all of you today, we got this amazing piece of news. Day trading restraints to be loosened under proposed rule change. US regulators are finalizing plans to replace the pattern day trading rule, which limits investors with less than $25,000 in their margin account from borrowing to trade 4 or more times in a 5-day period. Very quickly, just add a little bit of clarification. Pattern day trading is an archaic, stupid rule that exists in the US markets, and it is applied to margin accounts with less than $25,000. More specifically, it is a regulatory designation for those traders or investors that execute 4 or more day trades over the span of 5 business days using a margin account. And to put that in layman terms, if you have a margin account with less than $25,000 as of right now, as of the moment that I'm filming this video, you are allowed to only open and close a position 3 times within a rolling 5-day period. And by the time you hit your 4th one, well, you get in trouble. If you're watching this video, there's a very good chance that this exact rule has caused you to rip out your hair. All of a sudden, you see an opportunity that you can't take because you don't want to burn a day trade, or all of a sudden you're in a trade that you can't get out of and it's going against you, but guess what? You can't get out because you're going to violate this rule. Yes, we've all been there. It's all very painful, and if everything goes right, they're going to be kicking this rule to the curb. A proposal being prepared would lower the threshold to $2,000, and individual brokerages would make their own margin calculations and decisions as to the minimum balance that customers need to day trade. So basically, way better than $25K. I want to take a quick moment to pause and basically ask all of you, let me know in a comment below, do you agree with this, or do you actually think that the rule should stay in place? I don't think that many people are going to be in the latter camp. In fact, come to think about it, I don't think I've ever heard of a good argument of why we have pattern day trading rules, but hey, I'm obviously always open to looking at it from a different angle, always being proven wrong. So like I said, whether you agree or disagree with this rule, or should we keep it, should we get rid of it, let me know in a comment below. And as you are letting me know your thoughts, I want to share some extra stuff that I found out about this that I have to admit kind of blew my mind. The existing rule, adopted in 2001, this has been running for 2.5 decades, and it took that long for someone to figure out that maybe this is a stupid rule, was put in place to protect investors from massive losses and borrowing more than they can covering in holdings or cash. Industry executives say that the markets have evolved since, spurring FINRA to review the current requirements. Now, I know that that's a little bit confusing. What they're actually talking about is market structure and the fact that when you open and close a trade, even though in your account you saw you did it in a day, remember, especially back in 2001, it took even more days to settle. Right now, we're kind of, well, depends on what you're trading. You're either settling in 1 or 2 days, but back then it was 5 days or potentially even longer, once again, depending on what you were trading. So even in your account, even though you saw you open and close the trade in that day or in 1 day, remember, because of market structure, the trade didn't technically clear for a couple more days. And then when that adds up, that's where it's referring to of like, well, you're using money you technically don't have, even though you saw it in your account. Technically in the overall system, it didn't clear, so you didn't have the money. And yes, at a certain point, this was more because of the market structure. And as this is alluding to, technology has improved since then, but this entire idea of protecting investors, come on, man. Come on. Anyway, that's all well and dandy to know. The rule is old, it's stupid, whatever, it's time to get rid of it. The pressing question is when are things gonna change? As FINRA considers revising the rule, a group of retail brokerages met to discuss a draft of the proposal that is likely to be submitted to FINRA's board in the fall. If the board approves the proposal, FINRA, a self-regulatory organization of broker-dealers, is expected to submit it to the SEC for final approval by the end of this calendar year, the end of 2025. And even though that seems a good ways off, I have some bad news for you. More than 50 brokerages and clients have written to FINRA, which requests comments on a potential rule change in late October. If the current iteration of the proposal is sent to FINRA, it will then go through an additional comment period before progressing to the SEC. In actual actual rule change may take as long as a year to implement. So all of a sudden, we might be now talking about the end of 2026. A FINRA representative said the regulator has no update to share at this time beyond the October request for comments. Remember, you're allowed to have your voice be heard. You can comment if you so choose. Any change is likely to open up the market for more retail participation, given the lowering of the day trading threshold to $2,000. God forbid that we open up the markets for more retail participation. I absolutely hate it when the little guy gets an ability to take advantage of the large capital markets that surround us and generate and instill so much wealth in the elite class. God forbid the retail gets involved in that. In fact, that could quote unquote garner criticism from those who warn against impulsive day trading habits with fewer guardrails against excessive risk taking. A study from Stanford in 2024 found increasing market access will likely impair retail investors' performance. Outside the US, regulators have flagged their own concerns. A study from the SEC of India released this month found that 91% of retail investors report losses from trading equity derivatives, mainly options. Day trading on a margin account is risky, and that's why FINRA put the rule in place. Maybe they put the rule in place because it's quote unquote risky, and it is risky. I'm not blind to that fact. Or maybe, just maybe, and hear me out because this might be a crazy one, the entire establishment didn't want the little guy getting ahead. I know it's absolutely crazy to say people in positions of power don't necessarily have our best interests in heart, but maybe just a little bit of food for thought. But seriously, I absolutely know that trading is dangerous. In fact, I've heard percentages that are even higher. This cited 91, I've heard 95, 96, 97. Yes, a lot of active traders end up worse off than when they started. I think we could have an entire video series on why that happens, but in reality, I thought these were the large capital markets that we all have access to. I've never really understood the concept that certain groups, based on how much money they have a certain set of rules, but a different group, based on how much money they have a different set of rules. If anything, isn't it just still the free, accessible capital markets? Once again, I understand that active trading is not for everyone, but I've also never heard in the US of people going into the casino and then after 3 bets, someone walks in and says, nope, that's it. You're done for the next rolling 5 days. We'll see you roughly a week from now. In my mind, you dedicate time out of your own life to do a job, to work, to generate money. You have that money, and then you have the option to do what you want with it. If you want a sports bet, great. If you want to gamble, great. If you want to put it in the markets, great. If you want to invest, great. You can do what you want because I was under this idea that this is America and it's your money. I'm not your mom. It's your money. You're allowed to do with it whatever you want. I think I've made it pretty painfully clear in this video that I'm a massive supporter of them getting rid of this rule or at least greatly reducing it, which is how it seems it's going to go. Unfortunately, it seems like this regulation process is going to take a while. We might be talking about the end of 2026, but hey, that's better than nothing. Of course, I would love to hear from you and your thoughts in a comment below. I appreciate you stopping by. Don't forget, if you enjoyed this video, like, subscribe, all that good stuff. With that being said, I'll catch you in the next one.